Right now, the IRS is collecting money from seniors over 65 that those seniors do not legally owe, and if you do not claim these 4 specific exemptions before the end of 2026, that money is gone permanently. No refund, no notice, no recovery, just years of overpayment quietly disappearing into the treasury because no one told you the rules changed. IRS data shows the average senior overpaying these 4 taxes loses over $3,200 a year. That is money already earned, already belonging to you, sitting in federal accounts because the right forms were never filed. This is not about fraud. This is not about an error on your return. These are 4 specific exemptions written directly into federal law. And in 2026, the dollar threshold shifted in ways that now protect seniors who were just barely over the line last year. This is Retirement Watch USA, and the single most painful pattern we see is not fraud and it is not recklessness. It is careful, honest people in their late 60s and 70s paying bills they stopped owing simply because no one updated them on the rules. That is the most expensive kind of mistake there is because it is invisible. There is no notice. There is no penalty. There is just money leaving your account every single year that never had to leave. Here's the idea that holds all 4 of these together. Being legally exempt from a tax and actually not paying it are 2 completely different things. The law does not refund you automatically. Nobody mails you a check. You have to know the rule exists and you have to act on it. The gap between what is available and what gets claimed is not an eligibility gap. It is a knowledge gap, and that gap is costing seniors real money every single year. Before going further, there are 2 groups of people watching this, and both need to hear this directly. The first group is lower-income seniors living primarily on Social Security, maybe with a small pension, maybe with modest savings. You may assume these strategies are for wealthier retirees. They are not. Every single one of these 4 applies to you, and in several cases, you benefit more directly than anyone else. The second group is comfortable retirees with a pension, a brokerage account, Social Security, maybe a 401k they are drawing from. You may assume your income is too high for exemptions to apply. That is also wrong. Strategic timing and sequencing is what puts money back in your pocket, and every one of these 4 points will show you exactly how. Nobody watching this should walk away thinking this does not apply to them. Both groups talk themselves out of acting through different logic, and both conclusions are incorrect. That leads directly into the exact numbers because figures are the fastest way to prove the point to yourself. Chapter 1. The federal tax on your Social Security benefits. Here is the one that covers the most people. I want to be precise here because this is exactly where both groups of retirees get bad information. Here is the actual rule. Whether your Social Security is taxed depends on something called your provisional income. That is your adjusted gross income, plus any tax-exempt interest, plus half of your annual Social Security benefit. Start there. Just that one number. If you are single and that combined number comes in under $25,000, 0% of your Social Security is taxable. If you are married filing jointly and that number comes in under $32,000, the same result applies. None of it is taxable. Here's the win for each group. If you are a lower-income senior living primarily on Social Security with modest savings, there is a strong chance your correct federal tax on those benefits is already 0. You may be having money withheld from every single monthly check that you do not legally owe. If you are a comfortable retiree with a pension, a brokerage account, and Social Security, you are not locked out of this. Strategic Roth conversions and careful sequencing of which accounts you draw from in a given year can move your provisional income below the threshold or into a lower tax tier. The mistake that hits both groups equally is the W-4V withholding problem. When people file for Social Security, many check a box authorizing the government to withhold federal tax from every monthly payment just to be safe. Then they overpay all year and wait for a refund they may not even think to file for. Pay what you owe on time and not 1 cent early as a gift to the Treasury. File a revised Form W-4V with the Social Security Administration to right-size that withholding the moment your tax situation changes. This applies to your 2026 return. The window to act is now, not next year. That leads straight into the second point because it lives inside the same retirement account most seniors are already drawing from. And if you think the Social Security threshold is the only tripwire here, we are not at the worst part yet. Chapter 2. The hidden tax burden, inside your required minimum distributions under the Secure 2.0 Act, the age at which you must begin taking required minimum distributions from a traditional IRA or 401k moved to 73. A significant number of seniors are still operating on the old age 70.5 rule. That is not the mistake to focus on here. The mistake to focus on is this. Every dollar you pull out of a traditional IRA is ordinary income. It adds directly to your provisional income calculation for Social Security. It can push you into a higher tier, and if the number climbs far enough, it triggers the Medicare surcharge covered in the next section. Here is the rule that changes the calculation entirely for qualifying seniors. Under Internal Revenue Code Section 408D, 8. You are permitted to make what is called a qualified charitable distribution directly from your IRA to an eligible charity. In 2026, the annual limit on qualified charitable distributions is $108,000 per person. That transfer satisfies your RMD requirement. It counts as if you took the distribution, and it never appears in your adjusted gross income. For a lower income senior who gives regularly to a church, a hospital, or a charitable organization, this means your RMD obligation is met with no taxable income created at all. For a comfortable retiree who does not need the RMD funds to live on, this is a tool that can reduce your adjusted gross income by tens of thousands of dollars in a single year. Right now, before going any further, open your IRA account. Not last year's statement, the actual current balance. Look at the number, because the next section depends on exactly where that number lands and what your projected distribution will be for 2026. The 2026 thresholds are in effect right now. This window closes at year-end. The window to act is now. Chapter 3. The Long-Term Capital Gains Tax and the 0% Bracket. This is the one that generates the most surprise when walking people through it. Here's what most seniors do not know exists. Under current law, long-term capital gains are taxed at 0% for taxpayers whose taxable income falls below approximately $48,350 if single, or $96,700 if married filing jointly. Those are the 2026 figures. Most seniors with modest retirement income, Social Security, a small pension, and conservative withdrawals land inside that bracket and have no idea. That means if you have appreciated stock, a mutual fund, or any long-term investment you have been holding for over a year, you can sell it, take the gain, and pay zero in federal capital gains tax. That is not a loophole. That is a bracket you already qualify for. Here's the win for each group. If you are a lower income retiree, you may be sitting on appreciated assets and avoiding selling them because you assume you will owe tax. You may owe nothing at all. If you are a comfortable retiree closer to the upper end of that bracket, the strategy is called tax gain harvesting. You deliberately realize gains in a lower income year to reset your cost basis so future gains are smaller. The IRS does not prohibit this. There is no wash sale rule on gains, only on losses. Consider a retired registered nurse in her early 70s who had held a mutual fund position for 14 years. The gain was $31,000. Her tax preparer told her to hold it because she would owe capital gains tax. Her actual taxable income that year was $38,000, well inside the 0% bracket. She did nothing wrong. She held the position for 2 extra years, based on advice that did not account for her actual income level. That is a recoverable mistake, but it required someone to look at the real numbers with her. The 0% bracket is not automatic. You do not receive a notice. You have to calculate your projected taxable income, confirm you are inside the threshold, and then make the decision to sell. The 2026 brackets are in effect right now. The window to act is now. Stay right here, because the last one is the biggest surprise most seniors never see coming, and it is the reason this video exists. Chapter 4. The Medicare IRMAA Surcharge. IRMAA stands for Income-Related Monthly Adjustment Amount. It is a surcharge added to your Medicare Part B and Part D premiums. It is not called a tax anywhere on the document you receive, but it functions exactly like one. Here is how it works. Medicare looks at your income from 2 years prior to determine your current year premium. In 2026, Medicare is using your 2024 tax return. If your modified adjusted gross income in 2024 was above $106,000 as a single filer, or above $212,000 as a married couple, you are paying a surcharge on top of your standard Medicare premium right now. The standard Part B premium in 2026 is approximately $185 per month. Add the first IRMAA tier, and that number jumps to over $259 per month per person. The higher tiers go further still. Here's the win for each group. If you are a lower income senior, you are most likely below the IRMAA threshold entirely, and this section is your protection against crossing it accidentally. If you are a comfortable retiree who took a large Roth conversion in 2024 or sold a major asset, you may have inadvertently triggered a surcharge that you are paying every single month in 2026 without connecting the two events. A single poorly timed Roth conversion of $50,000 can cost a couple over $3,000 per year in additional Medicare premiums. The fix is understanding the 2-year lookback. Any income-generating decision you make this year affects your Medicare premiums 2 years from now. That is the planning window. And if your income spiked in a prior year due to a one-time event, a home sale, an inheritance, a large RMD, you can file Form SSA 44 with the Social Security Administration to request a reduction in your IRMAA surcharge based on a life-changing event. That form exists. Most seniors never file it. That is the 4th tax, the one that does not use the word tax. The one most people have been paying without ever knowing it had a name. The 2026 surcharge is being collected right now. If you qualify for a reduction, the window to file Form SSA 44 is open today. It will not stay open forever. Your action checklist. Step 1. Calculate your provisional income today. Add your adjusted gross income, any tax-exempt interest, and half your annual Social Security benefit. Compare it to the $25,000 or $32,000 thresholds. File a revised Form W-4V immediately if you are over withholding. Step 2. Confirm your RMD age. If you were born after 1950, your required beginning date is age 73 under the Secure 2.0 Act. If you give to charity, search IRS Qualified Charitable Distribution Rules for 2026 and confirm your organization qualifies before directing funds. Step 3. Pull your 2026 projected taxable income and compare it to the capital gains 0% threshold for your filing status. If you are below $48,350 as a single filer or $96,700 married filing jointly, identify any appreciated long-term positions you have been avoiding. Step 4. Locate your 2024 federal tax return. Find your modified adjusted gross income on line 11 of Form 1040. If that number exceeds $106,000 single or $212,000 married, you are in an IRMAA tier. Step 5. If your 2024 income included a one-time event, file Form SSA 44 with the Social Security Administration. Search SSA-44 Medicare Income-Related Monthly Adjustment Amount on the official SSA website. Gather your 2024 return and documentation of the one-time event and submit it directly to your local Social Security office. These 5 steps exist. The exemptions exist. The only remaining variable is whether you act before 2026 closes. The IRS is not going to call you with this information. Your bank is not going to flag it. Your Medicare statement does not explain it. The system gives back only what you ask for. Like this video, if it gave you something useful, subscribe to Retirement Watch USA so you never miss information like this, and share it with someone in your life who could use these 4 exemptions before the year closes out.